Welcome to another session of Business Startup Training. Today we'll be looking at debt to equity swap. What's the concept behind it? This is presented by accounting lecturer. All right, so we're going to move into what is debt to equity swap. So our objective is, by the end of the session, to get a better understanding of debt to equity swap for companies that are struggling. Now, let's look at the concept of defining debt. What is debt? And we're going to also look at what is equity, and then we're going to also move on to the concept of covenant. And then finally, we look at the debt to equity swap concept being demonstrated, and then we look at an example. Now, what is debt? Debt is something, especially money, that is owed to someone or a state of owing something. Now, so we can look at the concept of debt being you are borrowing from a person, a family member, a friend, or someone you're doing a business transaction with, and you're borrowing money from them. Or we can also look at the concept of you borrowing from a financial institution. So you're borrowing from a financial institution, you're borrowing from a friend. These are the examples of debt incurring. But now let's look at the concept of the accounting equation. Now, the accounting equation says asset is equal to liabilities. Asset is equal to liabilities plus capital. Okay. Now, this is the pillar by which we build everything. So in terms of the concept of debt, let's say a company borrows 500,000 and the interest rate is 7% per annum for 10 years. So the company that borrows the money needs to ensure that they have enough cash to service the 500,000 at 7% per annum. And you see the debt is 5 years. Now, this is quite high because interest rates right now is hovering around, well, the Bank of England is saying that they intend to have interest rates in negative at the moment. And so other institutions, you generally would look at interest rate between 3 to 5%, generally. So an interest rate of 7% is quite high. And that could be a reason for the risk of this company being very, very high. But that's not the main thing that we're looking at. The main thing here is looking at the debt. So the debt is a component of the aggregate financial situation of a company. The proportion of it, one proportion is capital, one proportion is debt, and the aggregate of the two is asset. But the debt being 500,000 at 7% per annum for 10 years is where we're going to look at and see even further what we can learn. So let's look at the concept of equity. Now, equity is the value of a company divided into equal parts. It's normally owned by shareholders. And the main concept here is the concept of equal parts, which is normally the value of the company, and it is also how it's divided. So let's say, for example, again, going back to the initial concept of asset is equal to liabilities plus capital. So assets here is, we're not going to consider asset at the moment. We're going to look at the capital side of it. So capital here is $1. Let's say we have $1. This is $1 per share. So each share, the company is divided into 1 million pieces in terms of the quantity of shares. But each share worth $1. So $1 times 1 million would give us 1 million share, 1 million in terms of the value of the equity side of things. Okay, so the value of the equity here would be 1 million. And as I said before, it's $1 per share and it's 1 million shares. So once we multiply that, it's a million in equity. So we've looked at the equity and we've also looked at the debt. Now let's look at the concept of a covenant. Now, a covenant is a formal agreement or a promise between two people. Now you might be wondering, why am I going with this? Now, when an institution or a company borrows from another, it enters into a contractual arrangement with that company with the obligation to pay them the interest or interest as well as principal. Now, in this example, we have 500,000 being in the amount that's borrowed. and 7% being the payment per annum. So 7% times 500,000 times 7% is 35,000 per annum. Now, if they're intending to pay back the principal, if we're looking at 10 years, then it's 50,000 per annum. So altogether it would be 75,000. Now, this company would break the covenant if the company only has the ability to pay back 25,000. So the covenant would have been broken. But generally, if the company is able to pay 85,000 rather, not 75, my correction, so 85,000, it would cover both the principal as well as interest. But if it's only able to pay 35,000, it would have, I'm assuming, also been able to meet the covenant, because that's the minimum requirement to actually be able to pay the interest. But if it only, can pay 25,000, the covenant would be broken, and therefore that'd be a big problem. And this is send off a lot of signals, and we might have penalties levied on this company, which will create other problems in terms of liquidity as well moving forward. Now let's look at this example that we've seen of Caffe Nero. There was an article written by Yahoo Finance on the 20th of February 2021, and we're going to look at that. Now, again, just to reiterate, asset is equal to liabilities or debt plus capital or equity. Now, there are two brothers, which is Mohsin Zuber and Issa, and they are billionaires, and they intend to buy Caffe Nero. They would like to. I think they recently bought Asda, and they intend to buy this company. Now, they are approaching one of the debt holders, it seems, and the debt currently that they're focusing on is the 250 million in debt that they're intending to take on. The intention is that once this is taken on, and it seems as though that this debt is due, and now I'm trying to deduce from the article my understanding. It seems as though this debt is quite critical, which means that it's due, which means that if it is broke, if payments are not made, then it's going to create problems in terms of financial shocks within this company. So the other important bit of information here is that the remaining debt, which maybe is not due at the moment, but it may be held by another company, is 238 million. So altogether, the aggregate debt here would be 490 million. Now, if this company were to have its debt bought by these brothers, Mohsin and Zuber Issa, they are going to have a situation where the equity side of it is not even material. So if the equity is 100 million, it's not material because the debt is too high. If the equity is 200, it's not material. If the equity even 500 million, it's like a 50-50 situation. And again, it's not material. The only way I think they would lose out is if the equity is about 600, 700, 800 million, and then they're buying the debt. Now, but then we're looking at, if we were to look at the depths of the accounting behind it, so if it is 600 and 700 million, it means that they should have some general reserve, which means that they should have some level of cash to service the debt. But that is maybe not the case. We do not have the information about the asset value, and we do not have information about the equity value. But the debt seems to be the big problem. I think this company is heavily laden, and with the fact that Corona took place and liquidity problems are setting in because there's next to nothing in terms of turnover over the last 12 months, because the government has actually asked these companies to close due to wanting to ensure that everyone's social distances. And so that is creating the problem here, whereby liquidity challenges setting in, and there's not an ability to service this debt. And therefore, we have, billionaires like these two brothers, Mohsin and Zuber, intending to buy this company. It seems as though it's going to be a battle, but the fact that they are buying the debt is going to make the company kind of crumble, in that allow their equity to be bought for next to nothing, because again, the equity would not be material because of the fact that the debt possibly is far greater than the equity. I hope this demonstrates the concept of debt to equity. Okay. So again, we've looked at what is debt. We've said that debt is something where we borrowed money from someone or an institution. We've also looked at equity. We said equity is, the various parts that a company is divided into, and it's normally a financial value, monetary value attached to each part. So again, in the example, we had 1 million shares, and it's $1 a share, so therefore the total equity was $1 million. The covenant, we spoke about the concept of the company having an arrangement whereby they need to either pay the interest as well, or interest and principal at set times. And if they're not able to do that, then the covenant would be broken, and therefore that would be causing financial challenges for the company, which is going to maybe cause penalties and possibly take over by others. I think that's what's setting in this situation with Caffe Nero, where they're struggling to pay their financial obligation due to being closed for several months. And and therefore these brothers, the Issa brothers seemingly, are going to try to capitalize on this opportunity and take it over. I hope that you've learned something from this. I know for the most part, the video was not on, but the main concept is to get you to have a better understanding of debt to equity, a debt to equity swap, where a company actually buys the equity, buys the debt, and therefore the equity is not material. I hope this demonstrates the concept. Like, share, subscribe. Thank you.